In a world where stocks seem to only go up and optimism knows no bounds, is it possible that investors are overlooking some glaring warning signs of overvaluation? Stick around to find out why some experts believe that the market, specifically the Magnificent Seven, are dangerously overvalued.
The Magnificent Seven seeing nice gains following Q4 earnings, with the group now up about 9% for the year. My next guest says while the names are richly priced, only one is, quote, priced to the point of insanity. Let's bring in the Dean of Valuation, Aswath Damodaran, NYU's Stern School of Business. Professor, welcome back.
Thank you for having me.
So, who is Aswath Damodaran, and why is his opinion important to us as investors? Damodaran is a professor at the Stern School of Business at New York University, where he teaches corporate finance and equity valuation. As mentioned in the clip, he's known as the Dean of Valuation and is considered a legend in the field, not only in the academic domain, but also worldwide with his immense contribution online, sharing his lectures and valuation material online for free for anyone to use and without any paywalls. He currently has over 1.1 thousand videos of great content on his YouTube channel. So if you haven't already, I highly recommend you to check them out after this video. I've personally learned a lot from him, and I'm sure you will too. Now back to the video. Damodaran believes that the Magnificent Seven, which are Apple, Microsoft, Google, Nvidia, Amazon, Tesla, and Meta, are currently overvalued, with one of them actually priced to the point of insanity. But which one is it?
The one that's priced to insanity, you suggest, is Nvidia, which is interesting because you own it along with all of the others, correct?
No, you bought these stocks at the right time. They were amazing buys at some point in time. At today's prices, all of the stocks looked overpriced. But I think Nvidia stands out as particularly overpriced.
So probably not a huge surprise. Nvidia, which is one of the best performing stocks in the last 5 years, is the one that Damodaran believes to be priced to insanity. Nvidia has soared 740% since the lows of October 2022 and over 2,000% since 2019. 2,000%. Definitely crazy returns. But as you know, rising stock prices don't necessarily mean overvaluation. The same can be said for the other 6 companies, which all had outstanding returns in 2023, outperforming the S&P 500's 23.3% return. In order to better understand Damodaran's reasoning, let's take a quick look at a couple valuation metrics for these Magnificent Seven companies. Starting with the trailing price to earnings ratio, you can see here that all 7 companies have a price to earnings ratio of over 25, with Google and Apple being the only 2 companies with a PE in the 20s, while the remaining 5 have a minimum of 34 PE, with Meta at 34, Microsoft at 38.8, Tesla at 40, Amazon at 61.7, and coming at the top of the list is Nvidia with a whopping 76.7 PE. To put this into perspective, historically, the S&P averaged a 16 PE, and despite the stock market being generally overvalued at the moment, it currently trades at a PE of 24.8, which is still lower than all 7 companies. However, high PEs alone do not really constitute overvaluation. We need to use other valuation methods that take into account future projected growth rates as well as other relevant factors to obtain a company's intrinsic value. There are 4 distinct valuation methods that I usually use. The most famous one, which is also used by Damodaran, is the discounted free cash flow model, which estimates the intrinsic value of a company based on the present value of its estimated future cash flows. The other 3 methods are the multiples valuation model, the dividend discount model, and the historical multiples valuation model. I've used these models to obtain the intrinsic value of all 7 companies, but for the sake of the video, we'll just go through one company together, which is Microsoft, as an example before I share the results of the valuation exercise. And don't worry, I will still share with you all the key assumptions that I made, as well as the link to the valuation models in the description below, just in case you would like to make any different assumptions or play around with the numbers. Starting with the discounted free cash flow model, you can see here the free cash flow that Microsoft generated over the last 10 years, growing at an average 11.3% per year. Based on analyst estimates, we use a 15% growth rate for future cash flows. Using a 9% discount rate, we get the present value of all future free cash flow as well as our terminal value. Adding them together, plus cash and cash equivalents, minus total debt, we get our enterprise value, which is the estimated total value of the company. Dividing the enterprise value by the total shares outstanding, we get a fair value of $338 per share, which is lower than Microsoft's current stock price, indicating overvaluation. The second method is the multiples valuation model, where we obtain Microsoft's fair value based on the multiples of its competitors and companies within the same industry. We do so by getting their current PE multiples, calculating the average PE, and multiplying it by Microsoft's current earnings per share to get our fair value, which is $358 per share. The third method is the dividend discount model, where we estimate a company's fair value based on the present value of future dividend payments. However, given that the Magnificent Seven companies either pay a very small dividend or do not pay a dividend at all, I decided not to include this model in our valuation. The last method is the historical multiples valuation model, where we estimate Microsoft's fair value by considering the normal PE ratios that the stock traded at historically. In our analysis, we will use a 5, 10, and 20 years normal PEs. As you can see here, the Microsoft stock was trading at an average 32 PE during the last 5 years, 23.8 for the last 10 years, and 19.4 in the last 20 years. We calculate their average and multiply it by Microsoft's current earnings per share to get our fair value of $277 per share. Finally, to obtain our intrinsic value and acceptable buy price, we take the average of the 3 fair value estimates generated by our models. The intrinsic value we get is $324 per share, which is 32% lower than the stock's current price. So, as Aswath indicated, even without a margin of safety, Microsoft looks to be significantly overvalued at the current prices. And just in case you're new to the channel or have not seen these valuation models before, we always want to have a margin of safety to protect against downside risk. Inputting our desired margin of safety here, say 10%, gives us our acceptable buy price, which in this case is $292 per share, significantly lower than the stock's current price. Again, if you would like a copy of these models, feel free to get one from the link in the description below and use whatever margin of safety you are comfortable with. Now, after going through the same valuation exercise for the other 6 companies, here are the results. Using a 9% discount rate across the board, 6 out of the 7 companies turned out to be overvalued, given our inputted assumptions. And as suggested by Damodaran, Nvidia turned out to be the most expensive one with an insane 77.6% overvaluation, despite projecting a very healthy growth rate of 30% for the next 10 years. Microsoft, which we just valued together, turned out to be the second most overvalued company with a 32% overvaluation, followed by Amazon, Tesla, and Meta with an overvaluation of 13.3%, 11.2%, and 10.6% respectively. Apple turned out to be only 2% overvalued, so basically fairly valued, which I honestly did not expect, while interestingly, Google actually turned out to be 10.4% undervalued, and the only undervalued company in the Magnificent Seven, using, in my opinion, relatively conservative growth estimates. One thing I would like to point out though is that I've only used the discounted free cash flow valuation method to value both Amazon and Tesla, mainly because these 2 companies historically traded at abnormal PE ratios, so using the other models would generate ridiculous and unrealistic fair values. By the way, I have conducted a comprehensive analysis and valuation of stocks like Google, Microsoft, and Nvidia on my channel, which you will find linked in the description below. Make sure to check them out for some detailed insights and potential risks associated with each company. And if you're enjoying the content so far, please smash the like button and subscribe to the channel. So, what does this all mean? Well, let's actually start with what it does not mean. And let's take Nvidia for example, given that it's the most overvalued company out of the 7. This does not mean that Nvidia is not a world-class company and a cash-generating machine. It also does not mean that Nvidia won't sustain attractive growth rates in the future as it continues to benefit from the generative AI boom. However, it does mean that at the current price levels, investors are either pricing in way higher growth rates for revenue, income, and cash flow, or they are willing to accept a much lower rate of return than 9%, which is what Damodaran touches upon in the next clip.
The truth is, when this process started, people assumed that NVIDIA's domination of AI, the chip part of the business, would continue in perpetuity. I think the other chip companies are waking up. Things are going to start to scale down. So I think in spite of the come down in price, I am more wary about NVIDIA than I was, simply because last time I valued it, NVIDIA was at $400. Gives me some kind of perspective in terms of at 682, I mean, that's a stretch that's given the current earnings potential and cash flows. I just can't get there. Maybe I'm just missing some part of the picture. But to me, it doesn't make sense.
So even at $682 per share, Demodern could not justify Nvidia's price, given its projected cash flow and earnings potential. As he said, the numbers just don't make sense. And the stock has actually risen another 38% since that interview. So the risk-reward ratio has become even worse. But what about AI in general, and investing in companies adopting and benefiting from artificial intelligence? Given the potential for disruption and revenue generation, wouldn't that be a sound investing strategy? Let's see what Demodern had to say about this.
I think AI has become this buzzword that people use to justify pretty much anything they want. I mean, I think collectively, AI is going to be a net negative for markets. It's going to be great positive for companies like NVIDIA. But I think the laziness with which people attach premiums to companies just because they see the word AI, and you see that partially with Microsoft as well, is, I think, terrifying because at some point in time, reality is going to play out and it's not going to match those expectations.
Quite an interesting take, and it's actually very true. According to a study conducted by FactSet, companies in the S&P 500 that mentioned AI in their latest Q4 earnings calls on average experienced better stock performance over the last 12 months compared to companies that did not mention AI at all. On average, companies that did mention AI saw their share price increase by 28.6%, while those that didn't saw their share prices increase by only 16.8%. Now, you might be thinking that's just a coincidence, and the difference in performance could probably be attributed to other factors, not just mentioning some words in an earnings call. If only we had some similar historical events in which specific technologies were excessively hyped, resulting in irrational valuations to any company even remotely related to that technology. Well, the good news is that there's actually multiple good examples throughout history. Let's take the dot-com bubble, for example, where just adding .com to a company's name actually resulted in the stock price increasing on average 74%. 74% just for adjusting a company's name. Pretty crazy, right? Obviously, no one can argue that the internet changed the world, but what happened to all the companies involved in the internet hype? Many of them experienced astronomical rises in their stock prices, driven purely by investor speculation rather than sound fundamentals. And when the bubble inevitably burst, countless companies went bankrupt, wiping out investors' wealth overnight. A quick look at the stock price of Cisco Systems, which was the tech giant of the dot-com bubble, similar to Nvidia and AI today, tells a pretty scary story. While Cisco is one of the few companies that survived the bubble and is still relevant today, the stock never actually rebounded back to the all-time highs of the 2000s, despite the company's fundamentals increasing significantly since then. Now, this is really not to scare anyone or to say that Nvidia is doomed. It is just a friendly reminder that hype and speculation can lead to dangerous market bubbles, and that investors should exercise caution when valuing companies based solely on their association with a popular technology trend, no matter how destructive it is. Now, despite the overvaluation that we generally observed in the Magnificent Seven, Demodern did suggest that there are two companies that could still provide an attractive proposition for investors. And this might come as a bit of a surprise. One of them he was actually buying recently. Let's take a listen.
I think there are two companies in this seven that if you really, really wanted to buy these stocks, you've never owned them, you say, I've missed out. One would be Tesla, which will surprise you because I bought Tesla just a couple of weeks ago at 180. And the other would be Apple, which I think is adjusted down. It's still a cash machine, but Apple over the last 15 years has lived from iPhone upgrade to iPhone upgrade. It has a bad year, then a good year based on whether there's a big upgrade during the course of the year. So I think Apple will bounce back a little bit. It's a slow growth cash machine, and people have to be realistic about what they're getting. But I think that at 188, it's as good a buy as any of the other seven. So Apple and Tesla would be my two buys among the seven if you really wanted to add two of these stocks to your portfolio.
So, a few takeaways from this clip. First of all, he made sure to clarify and emphasize that these two companies would be attractive for those investors who really, really want to buy a Magnificent Seven company, kind of implying that they aren't necessarily attractive investments for old portfolios at these prices. Second, he bought Tesla around $180 per share, and since then, the stock has actually declined to $169. So if you generally agree with his valuation and investment philosophy, you might want to look into Tesla. Now, out of the Magnificent Seven companies, I personally find Tesla the hardest one to value quantitatively. It only turned cash flow positive in 2019, and I think a lot of its potential value is dependent on your belief in management's execution and the company's growth outlook in potentially higher margin segments like energy and robotaxi. So despite the recent drop, at these levels, the risk-reward ratio is not very attractive for me personally. As for Apple, I do agree with them. You can't really go wrong with Apple. There is a reason why Apple currently makes up over 50% of Warren Buffett's portfolio. The company is basically a cash cow with a great track record of share buybacks. So with just some slight overvaluation, an argument could definitely be made for Apple. Now, my biggest takeaway is Google. I personally believe that Google makes up a much better risk-reward ratio than both companies. Based on my valuation, it is the only undervalued Magnificent Seven at the current levels, with great potential upside. If you want to know more about my reasoning and why Google is currently the most owned stock by super investors, make sure to watch the next video and don't forget to like and subscribe. Thank you very much for watching. Until next time.